All right, so we're now going to make points about the declining balance method and what calculations you have to do if you're going to apply that one. Again, we're using the same data set as we've seen before, but we have to do a couple of things differently. But how we get to the numbers is going to be interesting. So the historical cost number of 13,000, we're going to use that as our starting point. We do not have to calculate depreciable cost. So we don't really need the expected salvage value number. But what you guys are going to find is that we will end up having the book value at the end of the time frame on this asset be equal to that salvage value number. I do want to mention to you that we are going to be calculating what is referred to as the double declining balance method. I mentioned in a prior video that there are several different percentages that could be applied in a declining balance method. For example, 150% is one that some of my accounting majors will see in their upper level courses. But again, for our class, what we're going to do is we're going to do a double or 200% declining balance method. All right, so let's go forward with our information. A declining balance method is what we refer to as an accelerated method. What you guys are going to see is that for at least the first year, if not the first 2 or so years, the amount that will be depreciated to depreciation expense is actually greater than what the straight line method would come up with on a dollar amount basis. Over time, the amount will go from a large amount to a smaller dollar amount year over year. So it's going to be a decreasing annual amount of depreciation expense over the asset's useful life. And again, we're going to be using the double declining rate, which is 200% or double, and we're going to apply that against the straight line rate. If you guys think about what we saw on the straight line video, I said you could divide it by the number of years total. So if it's a 5-year asset with a 5-year useful life, then it's 1 year out of 5 years gave us the straight line rate for a year. So 1 divided by 5 was 20%. Well, this double declining balance is going to take that straight line rate, whatever it happens to be, and double it. Okay, so for our asset, we had a 5-year asset. 1 year out of 5 year gave us 20%. So then that means we're going to take the 20% and multiply it times 2 or double it to give us 40% for the double declining balance rate. What if your asset was a 4-year asset? What would you guys do for the double declining balance rate? First, you calculate the straight line rate. 1 year out of 4 years would be 25% straight line rate. If you double that, you have 50% for the double declining balance rate. What would you all do if it was a 10-year asset? 1 year divided by 10 years equals 10% for the straight line rate. And then if you doubled that, you would have 20% for the double declining balance rate. What if you had a 20-year asset? 1 divided by 20 is 5% for the straight line rate. If you double that, it would be 10% for the double declining balance rate. So be careful when you're doing your homework or a test question or a comprehensive final exam question. You first have to calculate the straight line rate, and then you double it for the double declining balance method. We're going to calculate that double declining balance rate, and we're going to apply it to book value. Now this is where it gets a little tricky. You guys need to make sure that you understand what book value is. We've talked about it. It's equipment common net. It is the historical cost of the asset minus the accumulated depreciation up to the date we're looking at. So let's take a look here at a tabular illustration of calculating the double declining balance method and applying it to our data set. What is our book value on day one of purchase? We have a $13,000 historical cost, what we paid for the asset. We haven't lifted a finger, we haven't driven the truck at all yet. Therefore, our beginning book value on day one of year one is the $13,000. We're going to take that beginning book value number and multiply it times the double declining balance rate. And this is the column where you have to say, what is our straight line rate? Our straight line rate was 1 divided by 5, or 20%. And then we're doubling it for our purposes for this chapter. So 40% is our double declining balance rate. Taking the 13,000, multiplying it times 0.4, we get an annual expense of $5,200 for year one and year one only. Journal entry remains the same. Increased depreciation expense, $5,200. Increase accumulated depreciation hyphen equipment, $5,200. Therefore, at the end of this first year, when we put together that balance sheet, we've got equipment, $13,000, and contra asset account, accumulated depreciation hyphen equipment, sitting now at $5,200. So what would equipment common net or book value be here? Well, same calculation as what you did for the straight line method. Historical cost, $13,000 minus the accumulated depreciation at this point in time, at the date, at the end of the year, $5,200. If we do that, our book value or equipment common net is $7,800. We saw on the prior slide that it said that when we do this declining balance method, we are going to apply this new rate, this double the straight line rate, against book value. So if you wanted to plug this into an Excel spreadsheet, this 7,800 is the equipment common net or book value at the end of year one. Well, it's going to roll over here, and it's going to be our beginning book value for the second year. And then we just follow the process again. 7,800 times 0.4 equals 3,120. Increase depreciation expense, $31.20. Increase accumulated depreciation by $31.20. That means that my number that goes right here is last year's amount plus what we're just now putting into it. Once we do that, we've got a total of $83.20 sitting in accumulated depreciation, and we can calculate book value again. Historical cost, $13,000 minus accumulated depreciation, $83.20, equals a remaining book value of $46.80. Again, take that number right there, roll it to the beginning for the next year. Multiply it times 0.4, which is double our straight line rate. We get our depreciation expense number. We increase depreciation expense by that for that year. And then our accumulated depreciation is going to be last year's total plus the depreciation expense entry amount for a total of $10,192. We can then calculate book value again. Historical cost, $13,000 minus accumulated depreciation of $10,192 equals equipment common net or book value. Again, take that 2808, roll it to the beginning, times 0.4, get a new amount for depreciation expense. Increase depreciation expense by $11.23. That's what's going to be on the income statement for that fiscal year or that calendar year. And then increase accumulated depreciation is the other half of that journal entry for $11.23. So $10,192 plus that dollar amount equals $11,315 sitting in accumulated depreciation. We could calculate equipment common net again. Book value. Historical cost of $13,000, whatever we paid for, minus what is sitting in the accumulated depreciation after that adjusting entry, $11,315. If we do that, we get $1,685. Take that book value, roll it to the beginning. Now I do want to say that sometimes we end on our last year of an asset and we have to tweak the numbers because sometimes it doesn't work out as perfect as we want it to. Alright, so on this one right here, we know that this remaining book value needs to be equal to what? And we know that this accumulated depreciation needs to be equal to what? Alright, so book value needs to be sitting at salvage value of $1,000. And this accumulated depreciation needs to be equal to the depreciable cost. So you guys could do this last row in one of two ways. You could either say the difference between $1,685 and $1,000 is a journal entry of $685. Or you could say the difference between $11,315 and $12,000 is also $685. When we do this kind of thing as accountants, we refer to it as plugging the numbers. We're plugging it and making it work exactly how we want it to. Okay? So if we were to multiply it times 0.4, I can assure you we would not get 685. It's off by a couple of bucks. Alright? But we want to plug it, so we're going to fill in the 685. Depreciation expense, $685. Accumulated depreciation hyphen equipment, $685. And get that accumulated depreciation balance up to $12,000, which would then result in our balance sheet showing equipment common net or book value of $1,000 left. Now, This particular example, we were applying this based on us purchasing the asset on the first day of January in 2017. But we've discussed this, and we've said not every company is going out and going shopping on the first day of the fiscal year or the first day of the calendar year, whatever the case may be. So, what would we do if this company had in fact purchased on April the 1st? Well, we can go to the next slide and take a look at another tabular example. Again, you guys could literally do your homework in an Excel spreadsheet. We would apply the same steps, but we would have an imaginary column in here that we would need to add in there for this partial year usage. Okay, I've already talked to you about how to calculate this percentage of the year. If you purchased it on April the 1st, you used it for 9 months out of 12. Think of it this way. You didn't use it for January, February, or March at all, so that's 3 months being subtracted from 12. So 9/12 or 0.75 of a year. You would still start out with beginning book value, which for day one, year one, is what you paid for it. 13,000 times 0.4 equals 5,200, but multiplying it times 0.75 would give us 3,900. Increase depreciation expense by 3,900. Increase accumulated depreciation by 3,900. And then you would calculate the book value and roll that column on over and get your book value of 9,100 and go through the process again. Again, notice what's happening on our last rows. If we've got accumulated depreciation sitting at 11,820 and we know we've got to get it to 12,000, that's a $180 difference. We need to increase accumulated depreciation by 180 to get that to work. At that same time, we would also increase depreciation expense by 180. Okay, so we would be plugging in that last year. All right, I'll do units of activity method in a separate video.